We are here to talk about tax strategies with Charlie.
I spent a career in the rat race, very successful, performing at the peak of my profession as a practicing CPA, but really not have accumulated the amount of wealth that I expected to by my early 50s. And so what I did is give away 30% of my CPA firm to the first employee that I hired, and probably the best technical accountant I've ever worked with in my entire life. And I used that time to find ways to grow mine and my clients' wealth more rapidly by, one, continuing to focus on tax strategies and saving people money on their taxes, but also trying to find ways to grow your wealth more rapidly by redeploying capital that was in market-based investments into two other categories: real estate and alternatives. And along the way, through a career of work, I stumbled across a couple of investment strategies that performed exceptionally well in these alternative and real estate spaces, and used that time that I freed up to ultimately find, vet, and make available to my clients and inner circle these opportunities. And this led me to a discovery. And, I've been counting people's wealth for north of 30 years, and I found a formula that many of my clients use to grow their wealth more rapidly. And I found the key criteria that were ultimately responsible for rapid wealth growth. And essentially, there's four things that determine how much and how fast you grow your wealth: how much you make, how much you save, how much you pay in taxes, and how well your investments perform. Most of the people that I work with do very good in terms of making an income from the job they occupy, the profession they practice, or the business they own. Many people do quite well in terms of savings, but the biggest mistake people make with savings is they put all of their money with a financial advisor and they invest in the financial markets. And at best, you grow your wealth at 6 to 8% over a career of work. That oftentimes requires you as an individual to work well beyond normal retirement age to accumulate enough capital to generate enough cash flow to sustain you for the rest of your life. 80% of your ability to grow your wealth more rapidly, or to push the retirement clock back by years, if not decades, is dependent upon two of the four factors: how much you pay in taxes and how well your investments perform. So as a wealth architect, my job is to focus on that 80% that matters. If I can recover dollars that you're paying in taxes, compound them in an investment strategy or program that gets you access to off-market investments that have the potential to outperform the market, then I'm going to drive your retirement clock back by many, many years. I'm also going to increase the amount of disposable cash flow you have on a monthly basis when you're living off of a passive income stream. And ultimately, I create more flexibility in my clients' lives by allowing them to engineer the day of their dreams. I like to talk about my clients, and I like to talk about how I help people. And many of you may know Dennis Prager. He has a nationally syndicated conservative radio show. I think he's broadcast over 1,200 radio stations. And about a month and a half ago, he invited me to Burbank, California, where his studio is. And he asked me to help him. He said, Charlie, I've had a CPA for many years. He's a personal friend of mine. I have a financial advisor that I've worked with for the better part of 20 years. I still feel like, as a California resident, that I'm paying too much in taxes. And so I said, Dennis, I would love to help you. He gave me his personal and business tax returns, and I looked at them, and in 30 minutes, I was able to identify a very specialized type of retirement plan that he could implement, and he could actually fund about $290,000 a year into this type of plan. And what's interesting is Dennis had this type of plan. It's called a cash balance pension plan, but he was fully funded and he couldn't fund any more in it. I go, well, Dennis, your wife is the chief financial officer of your business and she doesn't receive any compensation. And by the way, she's several years younger than you. If we added her to the payroll rolls, we can have her participate in your pension plan. And by the way, that's going to save you $145,000 a year on an annual basis for the next 5 years. And that 30-minute meeting that I had in Burbank, California, saved him $728,000 in taxes. This is what I do for clients. This is the opportunity. Everyone needs a tax strategy because taxation is the largest outflow of cash flow in your financial life, and it is the largest destructor of wealth because you're taking money out of your investment plan and you're not able to compound dollars. You're not able to increase your purchasing power. And this is an illustration I like to talk about here about the importance and the actual value of tax planning. This is an assumption that assumes that I have $500,000 in initial capital to invest and I can earn 18% per annum. And I'm at the 35% marginal rate bracket. If you're in California, you're typically in the 50 to 52 rate bracket. So the savings are even much higher if you're in a high state environment. This assumes, one, that I'm a really good tax planner and I can engineer a tax strategy and I can keep the earnings off your 1040. If I'm doing my job well as a practicing tax strategist, by the end of the first year, if I keep that income off the 1040, I have $31,000 in additional capital to invest. By year 5, that grows to nearly $600,000. Just saving money on taxation can double your investment capital in this illustration in a 5-year period of time. By year 10, it grows to $1.1 million. By year 15, it grows to $3.3 million. Having a tax strategy that saves you money and recovers dollars that you're leaving on the table is the most important thing that you can do in your financial life because it allows you to accelerate the way you grow your wealth. As we well know, the Biden administration has tried relatively unsuccessfully to make major changes to the Internal Revenue Code that would have affected nearly everyone on this phone call or on this webinar today. The agenda is still in place, and the Biden administration is still trying to make substantial changes to the Internal Revenue Code to raise revenue. These changes are largely targeted to upper income Americans. Without any changes that the Biden administration makes, our marginal rate of taxation goes up to 39.6%. They want to end the step up in basis at death. This is a big one. And these are a couple of issues that we really need to address politically. No more mega IRAs for the upper middle income Americans and the affluent. And potentially the Biden administration wants to eliminate Roth conversions. The Roth conversions are one of the most powerful tools that I use with my clients in terms of growing tax-free wealth. If I can help you grow tax-free wealth, and many of you probably don't know how to, I can substantially increase the amount of cash flow you have later on in life. And as you well know, we've got an $80 billion investment occurring to this day in enforcement and collection at the IRS level. And there's some revealing statistics that I'm going to share with you, and there's some ways that you can protect yourself from audit scrutiny as well as from collection enforcement. So this is an article that came back out in April of 21, and it says the IRS is the key to Biden's big agenda. And what had happened is the Biden administration tried to make all these changes to the code, and Senator Manchin from West Virginia and the senator from Arizona blocked those from happening. And so what the Biden administration did is, look, we got to increase revenues. We can't change the Internal Revenue Code right now in the political environment to do that. So what we're going to do is put a lot of money into the IRS, and we're going to increase enforcement, and that'll allow us to reach our revenue goals. And the reality is, for every dollar the IRS gets in enforcement, they will recover $5 in unpaid taxes. Every one of us would take that deal if we were presented with that investment opportunity. Invest $1, get $5 back. That's what's happening now. If you look across every IRS service center in America, there's a massive amount of hiring going on in the enforcement and collection divisions. The reality is, I am very well prepared for what is happening at the IRS level. There's a book that's published annually. It's called the IRS Data Book. It is the encyclopedia of audit statistics. It tells you what forms are getting audited, what line items are getting audited, what is being scrutinized. I'm probably the only bald accountant in America that reads this book from cover to cover. And out of this book, I have come across a number of statistics that are very important to you as taxpayers. There are a couple of forms on your 1040 that are what we call audit magnets. Forms that get audited at a much higher rate of incidence than any other form on the 1040. The two forms that are most highly scrutinized are Schedule C, which is where you report income from self-employment, and Schedule E, which is where you report your rental properties and your royalties and passive activities. This is one of the most important observations I have made as a practicing CPA. If you move activities off of Schedule E and Schedule C to an entity type tax return, you lower your chances of being selected for audit by a factor of tenfold or more. If, for example, I restructure my self-employment activities off of Schedule C to an S corporation, I drop my rate of being selected from audit from 4% down to 0.4%. If I move my Schedule E activities to a partnership tax return, I go from a 1.17% chance of being selected for audit down to 0.4%. The proper use of entity structures actually reduces your chances of being selected for audit by a factor of 10 or more. So entity structuring is one of the most important things that you could add to your financial life to protect yourself from being selected for audit. What else is important in terms of audit proofing? Avoid paying your taxes late. If you receive a notice that you have back taxes due, that notice is coming from the collection division of the IRS. If you go into an IRS service center, and I practice with a former group manager that spent 20 years in the Eastern District of Virginia, you notice that the collection division is right next to the examination division. Don't you think if you've got someone that's got a lot of back taxes that are unpaid prior liabilities, that ultimately feeds its way over to the examination division? It does. Never file your taxes late. It is okay to file your taxes up to the due date of the return, including extensions, but when you file after the due date, after October 15th, your chances of being selected for audit multiplies by a factor of 25. Ratio analysis. So there is a scoring system, it's called the DIF scoring system, and the IRS ranks every tax return for audit potential using a ratio analysis. I have very proprietary level software that has been created by former IRS agents that allows me to score your tax return before it ever gets filed for audit potential. And when I find ratios that are out of balance, we correct those and we make adjustments so that your return doesn't get flagged. The top three things that do get audited are travel, entertainment, and auto. Look, when you're traveling, you got to have receipts, you got to have documentation. When you have entertainment expenses, you have to be able to document the business purpose. And of course, for auto deductions, you got to have the mileage log when you're asked to present that. People ask me, Charlie, how do you on average recover 30% or more of what I'm paying in income taxes? Well, I tell people this is not rocket science. Every CPA has the ability to do the type of planning that I do, but most get too busy. They earn high fees from the compliance work and they end up pushing paper, and they get busy working 14 to 16 hours, oftentimes year round, and never have the time to sit down with you and engineer a tax strategy. My tax season starts in October and it runs through early March. That is the period of time when I can implement strategic changes in your financial life that are simply going to save you money. How do I do that? Number one thing that I do first is I look at business structures. Every entity type, whether you're using partnerships, limited liability companies, or corporations, they all have unique tax and legal attributes. What I do is use entity structures and their unique tax attributes to drive down taxation in your financial life. The proper use of business structures reduces your exposure to audit, and it also ultimately allows me to lower the amount that you're paying in tax. How do we take money out of our businesses, out of our investments, and out of our financial accounts? Determines how those dollars are going to be taxed. So I engineer strategies that allow you to have enough cash flow to support your lifestyle. Every additional dollar that we have available to us, beyond the things that we need to support our lifestyle, I move into an environment where we have more control over how those dollars are taxed. We volunteer to pay tax on the income that we need to live on, and we move every additional dollar into an environment where those dollars are not taxed currently. Why pay tax on dollars I do not need to live on today? That is all embedded in this whole strategy around compensation planning and how we take money out of our businesses and our investments. One of the things that many Americans and many clients of mine fail to do is to develop three different forms of wealth. Most of my clients do a really good job of developing wealth in an after-tax category where the capital that you invest, you've already paid tax on. Many people do a very good job of, say, using the IRA club to self-direct their IRA accounts, their solo 401ks, and so we develop tax-deferred wealth. What many Americans fail to do, however, is ultimately develop tax-free wealth in a Roth IRA. How can I create a Roth IRA if I have income that is over the annual contribution limits? It's very difficult to get a large Roth IRA if you're limited to just small contributions, or if you're potentially only doing a backdoor Roth IRA strategy. Well, I was exposed to a tax strategy about 20 years ago where we are able, through typically a conversion process, to accelerate the way that you grow tax-free wealth. Why is this so important? When it comes to cash flowing your lifestyle later on in life, we fill up the low tax rate brackets with income from our after-tax investments, income from our tax-deferred investments, and then when our marginal rate of taxation starts to approach the 20% or higher rates, we start to pull money out of our Roth IRA tax-free. If I can accelerate the way you grow your Roth IRA, I can potentially double the amount of cash flow that you have in your financial life later on in life.
When I first heard Charlie speak about this, it didn't quite resonate right away. So I want you guys to really pay attention to what he's about to say to you guys. This is the part of the presentation I want you to really, really hone down on.
And it's really one of the most important financial concepts that I teach. And this is a variation of what Peter Thiel did, who grew a very small $1,300 Roth IRA into a $1 billion Roth IRA. And what Peter Thiel did was, use a small Roth IRA to buy shares before his company went public. His PayPal company went public. That company went public at $50 a share, and the net worth in his Roth IRA grew to $50 million. And then he took that $50 million and invested it in a bunch of future startup companies, ultimately increasing that Roth IRA to $5 billion. Look, not all of us are going to get to $5 billion, but many of us are going to get to multi-million-dollar Roth IRAs using the strategy that was introduced to me over 20 years ago by a tax attorney. The strategy is called a preferred LLC, and this is a variation of the checkbook IRA LLC. We call the preferred LLC a Roth acceleration strategy. And what this does, it couples assets in a traditional and Roth IRA into a partnership limited liability company where we're limiting the growth of the traditional retirement account, which is tax deferred, and maximizing the growth of the Roth IRA. The way this strategy works is it focuses on growing the tax-free component in your financial life. And as you probably know from having worked at the IRA Club, your account must be open for 5 years, and distributions in that account are tax-free after age 59 and a half. I have many people that have been using this strategy for 10, 15 years, and now are like reaching that 60-year-old mark, and they're already starting to pull money out of this Roth IRA because they've reached a degree of financial independence using these strategies, normally not reserved until after you're, say, age 65 or so. How do we set this strategy up? We form a limited liability company in your home state, taxed as a partnership. It can be formed in one of the more favorable asset protection jurisdictions like Wyoming or Delaware or Nevada, but not necessarily has to be formed in any one of those specific jurisdictions. But we form a limited liability company, and the IRA assets that are at the IRA Club, both traditional and Roth accounts, get rolled into self-directed accounts. The bank account gets opened for the LLC, and then the IRA Club transfers the assets out of the self-directed account to the bank account, which you have checkbook level control over. The traditional IRA buys what we call A-class shares in the limited liability company that we formed, and the Roth IRA buys B-class shares. Why are there two classes of shares? Because each class of share has different economic rights. And the concept is we want to limit the growth of the traditional account, maximize the growth of the Roth IRA account. How do we do that? We do that by having two classes of shares, a traditional IRA account, which can be in the form of a 401k, solo 401k, simple or SEP IRA, or even a cash balance pension plan, will own what we call Class A shares. Those are all tax deferred accounts. The Class B shareholder is always your Roth IRA or your 401k Roth. The way the LLC is funded, 90% of your total capital comes in from your traditional tax deferred account, and 10% of the capital comes in from your Roth IRA. Well, what happens if I don't have 10% of the total capital in a Roth IRA? We simply convert what we need to make up the 10% in the Roth IRA account. Everyone today can do a Roth IRA conversion. And as long as the Biden administration is not successful with their proposed limitations on conversions, we can continue to do this in the foreseeable future. I tell people that it is of importance to get this strategy set up as soon as possible because there are legislative pressures out there that could potentially in the future eliminate the ability for certain Americans to make conversions. You can fund your Roth IRA, as I said, from a direct rollover from another Roth IRA account, from a conversion or an annual contribution. Most of my clients use the conversion methodology because it allows us to get a significant amount of money into a Roth IRA, especially if you're a high income earner and you're limited to not making an annual contribution or don't have the ability to fund the backdoor Roth strategy. Here is the way this strategy works from a Roth acceleration perspective. And this is very important that you listen to this. This is the magic behind the preferred LLC. The way the operating agreement is written in the LLC is we're going to give the traditional tax deferred account, which is normally an IRA or a 401k, a fixed annualized risk-free rate of return. That rate of return is tied to an interest rate index. It's called the midterm AFR, published monthly by the IRS. It's about 4.5% right now. So the only thing that the traditional IRA earns from the earnings on the LLC is the first 4%. Everything that this LLC makes on its entire capital above 4% per annum flows tax-free to the Roth. So if you've got an investment that's generating 18% per annum, I'm getting 14% of the rate of return tax-free in my Roth. This is a very powerful tool for individuals that have the ability to find high-performing investments. This is an illustration that shows the power of this strategy. And this is the $500,000 investment that can earn 18% per annum. Remember, the funding formula is 90% of the capital comes from a traditional account, $50,000 comes from a Roth. So I start with $500,000. Let's say that's all in a traditional account. I convert $50,000 in a Roth. That then goes into my LLC, and I make 18% per annum on that rate of return. After 5 years in my Roth IRA, where I started with $50,000, I'm going to have $551,000. By year 10, I have a $1.7 million Roth IRA. My traditional IRA, however, has grown very slowly because it's only earned 4 to 4.5% per annum. My traditional IRA grows from 450 to 592 by year 5, and to a little bit less than $1 million by year 10. If I had invested separately in a traditional and a Roth account without the benefit of this preferred LLC, I would have had a very different outcome. Investing separately by year 5, I would have only had $114,000 compared to 550 in my Roth. By year 10, I would have only had 262,000 in my Roth compared to 1.7. This is the holy grail of tax planning to grow your wealth in a very tax exempt environment. I can set this structure up in about 6 weeks. We form the LLC. We work with the IRA club to get the accounts funded and set up. The IRA club runs the money over to your bank account, and then you invest those dollars in anything that self-directed accounts can invest in. And if you need help finding those opportunities, we certainly can here at my company help find high-performing investments that have the potential to outpace market-based investment returns.
Charlie, let me ask you a question. So just for those of you that are just going to take a step back, Charlie's a CPA. I'm not. He could say whatever he wants about tax strategies, and I know a lot of his tax strategies because I learned them through him. So if something, again, does not resonate to you guys, please schedule the call with Charlie, because Charlie could just actually really, and I know some of this is just going right over your head, but he could actually break this down further for you. Another problem that I already had somebody in a chat, by the way, Charlie, reach out to me saying, well, I don't have $500,000 inside of my IRA, my traditional IRA. Is there, can this concept work for somebody, let's say, who's got 100,000?
This strategy works at any level. I use $500,000 for illustrative purposes, but look, here's the key point. On an investment that generates 18% per annum, I'm able to double the size of the Roth IRA every year. So it works with $25,000, $100,000, $500,000. It works at any level of capital. And no better time than now to start with this strategy to get that 5-year clock running. This makes a big difference in terms of how much wealth you ultimately accumulate in your life. It is a wealth acceleration strategy, and this works magic once the strategy is set up and you're using it. We do all the hard work behind the scenes. We do the annual valuations. We keep track of how much is growing in each of the retirement accounts. It's very easy to administer and manage. And if you look at this, if you think about what amount of cash flow does this allow me to create, and how much additional cash flow can I create in my Roth IRA over a period of 5 to 10 years. If I simply invested my Roth IRA at 18% per annum, after year 5, I'm going to have about $21,000 a year in cash flow. By year 10, that's $47,000. If, however, I use this strategy, my tax-exempt income is just under $100,000, a 5-fold increase compared to investing separately, and it's $300,000 of cash flow annually after a 10-year period. This makes a huge difference in your financial life. And the reality is, if you invested separately, right, you're going to have a large buildup in your tax-deferred account, which is ultimately going to be taxable when you draw that money out. This is tax-free income, guys. Think about the additional monthly cash flow that you have after paying your taxes. This makes a big difference in your financial life. There's really no risk with the strategy. The risk is in the underlying investment. We've got to be able to find high-performing investments. This strategy works well when you have high-performing investments. That is the key to making the waterfall into the Roth work. This is the key to growing a Roth IRA, very much like Peter Thiel did. We've got to be able to find risk-adjusted rate of returns that outpace market-based investments that allow us to generate upper-teen rates of return on an annualized basis. My most successful clients diversified their market-based capital responsibly into passive investment real estate and alternatives. And this is what we call the three-legged stool. Diversifying your capital into these two other asset classes does two things. It gives you the potential to improve your overall rate of return beyond what market-based investments generate. And secondarily, it allows us to embed tax strategies that ultimately oftentimes keep the income off the 1040, and secondarily allow us, like using the preferred LLC, to grow tax-free wealth. So over a career of work, I've seen every form of investment from A to Z as a practicing CPA. I've seen every success. I've seen every failure. And about 7 years ago, I had a client who was a commercial real estate developer in Montreal, Canada, that happened to do a fair amount of work in Chicago, and I did his US-based taxation work. And he came to me one day and says, Charlie, I have an individual that is a cousin that was trained for 7 years by the head of Forex trading at Goldman Sachs. And he's been trading friends and family accounts. And he took one account from $800,000 to $3.8 million over an 18-month period of time. And he goes, I'd like you to look at this. And of course, as a left-brain, risk-averse, bald accountant, I said, too good to be true, once off, very successful, not stable, not predictable. About this time, I'm working with an individual, much like I hope to be with many of you, who was a client of mine. He happened to be a managing partner at PricewaterhouseCoopers. He was retiring early at age 52, and I was simply engineering the tax strategies around his buyout, his partnership exit, putting the business structures in place, and trying to save him money on the taxation associated with large payments from selling his shares as a partner back to PwC. And this guy, his name is Surjit Kaur, happened to have a PhD in aerospace engineering. So I shared with him the trading reports for this Forex strategy. And I said, tell me every reason why we should not put any capital into this strategy. And he came to me 6 weeks later and told me, look, I think you and I, Charlie, should put our own capital into this strategy and give the trader very specific parameters in terms of what they could and couldn't trade. And ultimately, we did that for a year and a half, and we got very predictable, very stable results. Our accounts didn't grow to $3.8 million, but they grew at a rate of return well beyond any investment that I'd ever been exposed to over a 30-year career of work. And that was the genesis for the 12X Wealth Trading Strategies Fund, which I'm going to share with you today. What we do in this fund structure, which has essentially been in existence for about 180 weeks, we trade 6 currency pairs. We trade the major currencies in a Forex environment: the US dollar, the British pound, the Japanese yen, the Australian dollar, the New Zealand dollar, and the euro. Since the inception of this fund, which dates back over 3 years, every week that this fund has been in existence has generated a net profit, except one. 180 weeks out of 181 weeks of net profitable trades. The rates of return per week average about 1% per week over the entire trading cycle. Some weeks we don't trade. The market that we trade in has to have certain characteristics associated with it for us to deploy capital. When the market's not right, we do not trade. This is all human factor trading. None of it is algorithmic. None of it is automated. There are 5 performance criteria that define the return profile in this fund. 184 winning weeks. Of the trades that we make, 75% of our trades win, 25% of our trades lose. The size of the winning trades, however, outpace the size of the losing trades by a factor of 12 to 1. Big wins, small losses. We only trade in any given trade 1 to 3% of the capital. We trade no more than 12 to 15% of the total fund at any given point in time. And on average, we trade 1 time per week. This fund structure has been going on at this level for nearly 3.5 years. The fund structure and the return profile allows us to generate a very high fixed rate of return to our clients. We have 2 retirement plan funds for our clients to participate in. We have a fund for accredited investors, and we have a fund for what we call qualified purchasers. A qualified purchaser is anyone worth more than $5 million. These funds can take dollars from traditional IRAs, solo 401ks, and Roth IRA accounts. The minimum investment is listed here as $150,000. It's actually $100,000. When you're making up your minimum investment, you can make that up with retirement plan dollars and after-tax dollars. You can mix and match to get to the minimum requirement. This fund requires a 2-year capital commitment with 1-year anniversary dates thereafter. What that means is you agree to invest for a 24-month period of time. After 24 months, you have the option to renew for another calendar year, and you have the ability to do that successively for each year thereafter. This fund generates a fixed 19.3% rate of return for accredited investors and 19.9% for qualified purchasers. Earnings are distributed on a quarterly basis from day one when your capital is placed into the fund. Earnings can be taken out at any quarterly point in time. Quarterly reports are issued on the 15th of the month following the close of the quarter, and distributions are processed on the 25th of the month. For those of you who are looking for high teen rates of return from day one, that are looking to increase the amount of cash flow that you have today in your financial life from your investment portfolio, these fund structures fit exceptionally well for you. For those of you who have the opportunity to create the preferred LLC, we are able to double the size of that Roth IRA annually in this strategy. This strategy doubles your capital after 3.6 years. And again, I've been fortunate to have discovered this strategy in the twilight of my career. Between myself, Surjit Kaur, who ultimately became the fund manager, and my CPA partner, Jamie Finnan, we individually are the largest shareholders in this fund. And as I said, I have not been able to find an investment that cash flows at this level from day one. Real estate can catch up to it typically by year 4 or 5, but I have something that I believe no other private equity company has. You can get access to this strategy at Goldman Sachs, but you got to bring a minimum of $20 million to be part of the club. I have something that every accredited investor in America can participate in. I have something that allows you to grow that tax-free bucket of wealth when you're using your retirement plan assets. I'm happy to have a conversation with anyone and everyone about how this fund structure can fit into your overall investment plans.
Thank you for all attending. Charlie, we'll touch base soon. Good, sir.
Thank you, guys.
Thank you, guys. Bye-bye.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.